So the second part of this that's very interesting is what silver has done in these rate cutting cycles. And if you look at the last three, for example, silver has actually averaged over a 300% gain in the rate cutting cycle.
You're watching Silver News Daily. Subscribe for more.
Did you know that 2024 could be the year silver skyrockets to $1.50 an ounce? With the Fed poised to slash interest rates and global demand for silver hitting record highs, the stage is set for an explosive price rally. And if you think this sounds too good to be true, stick around, because we're about to dive into exactly why Peter Kroth, one of the most respected voices in the precious metal space, believes this could be a once-in-a-lifetime opportunity for silver investors.
So you're right. There was a pullback, and the pullback actually came. So I guess every instance is a little bit different. What's interesting is that in the 2008 instance, you had a crisis, right? So you had everything sell off. You had gold sell off initially as well as silver. And in that case, the price of silver actually dropped concurrently with the rate cutting cycle. And then, as I say, as we got through to about the middle of that recession and the middle of the rate cutting cycle, then silver did take off. I measure from the bottom. So from about the time, as I say, about the middle of the rate cutting cycle, and from obviously from the time the silver price has bottomed. So, and then when we look at 2020, when COVID hit, that was maybe I'm going to say a little bit less dramatic, but you did see silver go from about $16 pre-COVID to 12. And that took a matter of maybe a few days or a week or so. It was pretty quick sell off. And of course, we had rate cuts. They didn't last as long. That recession was very short because printing was dramatic, combined with rate cutting. And silver took off very quickly, went from $12 to $30 in a matter of about 5 months. I remember that very clearly. So it was a tremendous time to be exposed to silver prices.
Right now, the silver market is on the brink of something big. Over the past few months, we've seen silver prices hovering near the $1.30 mark, but that could just be the calm before the storm. As Peter Kroth pointed out, silver is in a unique position where several powerful factors are converging to push its price higher. We're talking about a market that's not only fueled by investment demand, but also by its critical role in industries like solar energy and electronics. Kroth has noted that while silver prices have experienced some corrections, the underlying fundamentals remain incredibly strong. The silver ETF and futures contracts have shown a significant decline in inventories, indicating that the supply is tightening while demand continues to grow. This is particularly true in places like China, where silver imports have hit record highs. What we're seeing is the early stages of a squeeze, where demand outstrips supply, and this is often the precursor to a major price breakout. Add to this the anticipation of the Fed's rate cuts later this year, and you have a recipe for a potential silver boom. Investors are starting to realize that with interest rates set to drop, the opportunity cost of holding silver decreases, making it an even more attractive asset. And it's not just about speculation. This is about positioning ahead of a major market shift that could see silver prices reaching levels we haven't seen in decades.
Oh yeah, I sure do. I mean, it's interesting. There's a chart that was put out by the Incrementum Group. This is Ronnie Stoferla who publishes the In Gold We Trust report every year. And what they did was they looked at how gold behaves during rate topping cycles. In other words, you get these cycles where the Fed and other central banks will raise rates. And at one point they pause. So they've reached that point where they stop raising rates. The rate stays at its peak for a while, and then they eventually start cutting. So what happens with gold is that gold tends to take off when you reach a point where the central bank has paused. So at the end of their rate hiking cycle. And we've been there for a while. Gold has taken off. So that's certainly, repeated once again. When I saw that chart, I thought, well, I need to go back and look and create the same chart for silver because no one's done that yet. And it was very, very interesting because what it revealed to me was that um, two things. One is that silver will do the same thing. Silver will rise as well in these cycles, but later than gold. Silver actually starts rising about halfway through the rate cutting cycle. So we're just about to get into this rate cutting cycle, arguably. I think it's quite likely the Fed will cut in September. So as I say, traditionally, historically, what happens is silver starts to rise about halfway through, or rise at least significant, starting halfway through the rate cutting cycle. So, that doesn't mean silver can't rise now or soon. It's just that it'll really start to take off. And that could be, who knows, early next year, maybe late this year, depending how many cuts come and what the final total cuts end up being. But so the second part of this that's very interesting is what silver has done in these rate cutting cycles. And if you look at the last three, for example, silver has actually averaged over a 300% gain in the rate cutting cycle. So the last three were 2000, 2008, and then in 2020 when COVID hit. So it could be very exciting going forward for silver. As we know, rate cutting is about to start and it's likely to continue. I believe these usually are perfectly timed with a recession. That's why, because of the lag, that's why they start cutting. They've seen enough effect from the rate hiking. So these coincide with recessions. And so I think we're going to see some significant cuts over the next, say, 12 months or so. And I think that is just going to be rocket fuel for silver.
To truly grasp the magnitude of what's coming, we need to look back at how silver has performed during previous Federal Reserve rate-cutting cycles. Historically, these cycles have been a game changer for silver, often leading to substantial price increases. According to Peter Kroth, silver has averaged over a 300% gain during past rate-cutting periods. That's right, 300%. We're talking about the kind of returns that can transform an investment portfolio. So, what happens during these cycles? When the Fed cuts rates, it lowers the cost of borrowing and reduces the returns on traditional savings in investment vehicles like bonds. This shifts investor interest toward alternative assets like silver, which not only retains value but often appreciates significantly as demand increases. Kroth emphasizes that silver typically lags behind gold at the start of these cycles, but then catches up with a vengeance, often surpassing gold's performance in percentage terms. Right now, as we approach the next anticipated round of rate cuts, all the signs point to a repeat of this pattern. The smart money, those who understand how these cycles work, are already positioning themselves. They see what's coming, and so does Peter Kroth. He believes that we're about to witness one of the most significant silver rallies in modern history, and it could start unfolding sooner than most people expect.
Well, I mean, I'll be honest. I think that how can I put it? I'm cautiously optimistic, I guess, because yes, we've seen gold in particular. That's the standout at 25. Even this morning, we were looking at 25, in fact, and it's come back slightly as we're speaking, but obviously record highs, very impressive. But I cannot help but think that we could still see a little bit of, I guess, some correction potentially, both in gold, even and in silver. The reason I say that is for twofold, really. One is that the equities for both have not followed. Yes, they've risen, but nowhere near the same extent. I went back and looked at some charts of GDX, for example, SIL, the gold and silver ETFs. When gold was higher a couple of months ago, you saw these ETFs actually at higher levels than they are today when the metal is at now a higher price. So to me, that says those equities have not followed. So the other thing that I track is the outstanding positions, open positions on long contracts held by what we call commercial traders or commercial investors in the futures markets. This is both in gold and in silver. And the reason that I track them is because they're considered to be the smart money in the futures arena. And so you can imagine you've got large traders, you've got banks, you've got investment banks, you've got the large miners who really want to protect themselves on a potential downside, in a potential fall in the prices of gold and in silver. So what you see is when the metals prices tend to be, let's say, relatively low, then their outstanding contracts are their net short is relatively low, if not zero. When when these metals prices have run up, then they're protecting against some downside. So what I've seen is that they are actually at relatively high levels right now for in terms of protection for both metals. So that tells me that they see these metals at relatively high prices. They have concerns that the metals prices could come down. Now, don't get me wrong, I'm as big a bull in both of these metals as anybody. But I guess, on a near-term basis, and when I look at these indicators, which I regularly do, there is some risk, reasonable risk that we could see, near-term corrections in the prices of both metals. And so that's why I temper my very bullish outlook, absolutely, as we go forward. And as I say, the stocks haven't followed, so they remain very attractive. But naturally, if the metals correct, I'd expect the stocks to correct as well. And again, don't get me wrong, even medium term, this is going to be, we're very likely to end the year much higher than where we are now. I just think we could have a little bit of rough time over the next, say, few weeks or month or so.
Now, let's turn our attention to the industrial side of the equation, because silver isn't just a precious metal. It's an industrial powerhouse. Over the past few years, the demand for silver in industries like solar energy, electronics, and electric vehicles has skyrocketed. And this isn't just a passing trend. This is a fundamental shift in the global economy, with silver at the very center. Peter Kroth has been particularly vocal about the role of industrial demand in driving silver prices higher. He points out that the solar industry alone has seen an incredible surge in silver consumption, with a 6 to 4% increase from 2022 to 2023, and it's expected to rise even further in 2024. This isn't surprising when you consider that silver is a critical component in photovoltaic cells used in solar panels. And as the world continues its push towards renewable energy, the demand for silver is only going to grow. But it's not just solar. The rise of electric vehicles and the ongoing expansion of electronics manufacturing are also key drivers of silver demand. China, in particular, has been a major player, with its industrial demand for silver reaching record levels. Kroth emphasizes that this industrial demand creates a strong floor under silver prices, even when investment demand fluctuates. What's more, as these industries continue to expand, the pressure on silver supplies will only intensify, setting the stage for a significant price increase. This isn't just speculation. It's a reality that's unfolding before our eyes. The combination of growing industrial demand and tightening supply is creating a perfect storm for silver, one that could send prices soaring as these trends continue to accelerate.
I'm cautious, I think, because, as I say, certain sentiment indicators. Another one that I hadn't mentioned earlier was the bullish percent gold miners index. So this you can track yourself. It's BPGDM is the index, and it's a percent. It tells you the percent of gold miners that are trading in a positive momentum or in a negative momentum, or at multiple week highs. And if you're anywhere above 70, then it looks typically overbought. If you're anywhere below 30, it's looking oversold. Well, right now, last I checked, we're somewhere around 78. And so it's certainly overbought. It's been at 90, over 90 recently. That doesn't mean it can't continue to be even more overbought. But if you combine that with what I was saying earlier about how commercial traders are net short in both gold and silver, I would err on the side of caution. And maybe for the physicals, hold off a little bit. When it comes to a lot of the equities, maybe less the larger cap, but the juniors have still, I think, for the most part, yet to have had their run. I'd be more willing to allocate at least incrementally to some juniors. Um, Certainly, if the metals sell off, they will come off as well. But you can never know if that's going to happen. You can never know to what extent. So, if you are interested in some juniors, I think it makes sense to at least, as I say, start to buy in tranches, start to buy incrementally.
Fantastic. And if our viewers are interested in learning more, where can they find you?
So one of the best ways is to follow me at my where I publish my work, silverstockinvestor.com. We've talked about this before. I published a book called The Great Silver Bull, which is really more of an overview of the entire opportunity, what I call a generational opportunity in silver. You can buy that on Amazon, The Great Silver Bull. My newsletter, Silver Stock Investor, really is more of a real-time way to follow what's going on in silver. And more and more I'm hearing very well-rounded, sophisticated investors are saying gold's fantastic, but silver gives you even more potential. It has not kept up with gold, and so the leverage on the upside is likely to be even higher. It really has a lot of catching up to do. Other than that, I'm on Twitter. I'm on LinkedIn. You can find me at Peter_Kraut on X. I'm on LinkedIn, Peter Kraut, and those are the best ways to follow my work.
While industrial demand is certainly a key driver, we can't overlook the massive influence of retail and investment demand on the silver market. Over the past few years, we've seen a surge in retail investors turning to silver as a hedge against economic uncertainty. But what's really interesting is how this retail demand is evolving and what it means for silver prices moving forward. Peter Croft has observed that while there's been a significant amount of retail selling, especially as silver prices approach the $30 mark, this trend is far from over. In fact, many of those who wanted to sell may have already done so, particularly those looking to cash in on recent gains. But here's the catch. As retail selling starts to taper off, the available supply of silver on the market could shrink dramatically. Croft points out that once the selling is exhausted, we could see a significant tightening in the market, which would further exacerbate the existing supply deficit. What does this mean for investors? Simply put, it's a classic case of supply and demand. With retail selling potentially drying up and industrial demand continuing to surge, the market could be on the brink of a significant shortage. This would create a scenario where any new demand, whether from investors looking for a safe haven or from industries needing silver for production, could drive prices sharply higher. Croft emphasizes that we're approaching a critical juncture. The smart money knows that silver is undervalued at current levels, and as soon as the supply dries up, we could see a rapid escalation in prices. This is why positioning yourself before this happens is so crucial, because once the market realizes just how tight the silver supply has become, it could be too late to capitalize on the opportunity.
I mean, I agree. We started to see the premiums creep up. The markets are quite tight, especially, on the physical side. It's impressive. The retail investor certainly has come back into this market. And I have something I'll come back to in a moment. But the first thing I want to say is that you've got some big retailers that have now gotten into the bullion business. You've got Costco that's been selling for some time, gold and silver. Walmart has gotten into that as well. Costco is now selling anywhere from somewhere around $200 million worth of gold and silver per month. That works out to, if my math is good, almost um, to over $2 billion a year. I mean, it's just $2.5 billion a year. It's just tremendous. Costco alone, and by the way, Costco, it's one of the few things they will not take back from customers. No returns on gold and silver. Walmart is now selling this. And so it's just, it's tremendous. People have really, I think the inflation bug has really started to bite. People realize now they are looking for alternatives. They are realizing what precious metals will do to help protect their buying power, and they've turned to this market. They see what it can do for them, and has been doing. Gold at $2,500. That's really no doubt going setting off a light bulb in a lot of people's minds.
As we dive deeper into the silver market, it's essential to understand the broader economic and geopolitical context that's shaping the landscape. We're living in a time of unprecedented global uncertainty, rising geopolitical tensions, economic volatility, and shifting power dynamics are all influencing where investors are putting their money. And silver, as both a precious metal and an industrial commodity, is uniquely positioned to benefit from this turmoil. Peter Croth highlights that in times of uncertainty, silver often shines as a safe haven asset. But unlike gold, which tends to be more directly impacted by investor sentiment during crises, silver's dual role means it also benefits from ongoing industrial demand, even as it serves as a hedge against economic instability. This makes silver an incredibly versatile asset, one that can thrive in both inflationary environments and periods of economic contraction. Consider the current geopolitical landscape. Tensions between major powers, trade wars, and economic sanctions are becoming the norm rather than the exception. These factors are driving countries to rethink their reliance on the U.S. dollar, leading to increased interest in alternative stores of value like silver. Croth emphasizes that as more nations and investors seek to diversify their holdings away from traditional currencies, silver will likely see a surge in demand, further tightening the market. But it's not just geopolitical tensions that are at play. The global economic outlook is increasingly uncertain, with many experts predicting a slowdown or even a recession in the coming years. This economic backdrop, combined with the Fed's anticipated rate cuts, creates a scenario where silver could outperform many other assets. Investors are looking for safe places to park their wealth, and silver's unique combination of industrial utility and precious metal status makes it a prime candidate. Croth's take is clear. The current global environment is setting the stage for a silver rally like we haven't seen in years. As these factors continue to unfold, silver's role as a safe haven and essential industrial commodity will only grow stronger, driving prices higher as demand continues to outpace supply.
By mining and recycling. And so I did some research, and to me, the answer was that industrial users, in particular industrial users, were able to tap into this secondary supply. They could go to the futures markets, they could go to the ETFs, they could hold long futures contracts, let them mature, and then take physical silver in delivery. They could hold ETF, buy an ETF with cash, and say the next day, I want delivery. And if you own enough of certain ETFs, you can take physical delivery of the underlying metal. So that's what I believe that they've done, because we've seen the inventories in these different sources actually come down pretty dramatically since early, depending on which market, from early to mid 2021. And I think that's what has, since capped the silver price. You've had this big consumption of silver that was able to go to stockpiles of silver, really, without forcing miners to produce more to meet this excess demand. Well, those stockpiles have been drawn down. They're not completely empty, but they've been drawn down pretty considerably. I'd say to the tune of about maybe 60 to 70% overall. So there's a little bit of an overhang that can change overnight. I think at most we've got, at this point, maybe 6 to 12 to maybe 18 months of that ongoing, I'm not even sure that these inventories would allow themselves to be drawn down quite that much to have to be almost at zero. If they did, it would be dramatic, and someone would come and have one of these contracts and say, "Okay, my contract is now matured. I want delivery," and the exchange has to tell them, "I'm sorry, we're out of silver. You're going to have to take cash, a force majeure, and you'll have to take cash instead of the physical silver." And they'll say, "No, I want the silver," and that's when we'll hear about it as a headline, and that would be a spark that would just sort of ignite a big silver squeeze. So I think that has been, as I say, a bit of an overhang over the silver price. That's going away. We've seen these inventories really shrink. And going forward, I think that that's going to be very much reflected in the silver price. The miners have proven themselves unable to keep up with this increased demand.
One of the most critical aspects of the silver market that often goes unnoticed is the structural deficit that has been building for years. Unlike other commodities, silver has been in a consistent supply deficit, meaning demand has outpaced supply for an extended period. This is not just a temporary imbalance. It's a fundamental shift in the market that could have profound implications for silver prices in the near future. Hayder Croft has been vocal about the significance of this structural deficit. He points out that while silver mine production has remained relatively stable, the demand, particularly from industrial sectors, has continued to grow year after year. This ongoing deficit is not just a short-term phenomenon. It's the result of long-term trends that are unlikely to reverse anytime soon. What does this mean for the market? Simply put, as the deficit continues to widen, the available supply of silver is becoming increasingly scarce. This scarcity is further exacerbated by the depletion of above-ground silver inventories, which have been steadily declining as industrial users and investors tap into these reserves. Croft notes that once these stockpiles are exhausted, the market will be entirely dependent on new production to meet demand, a scenario that could lead to sharp price increases. But here's where it gets even more interesting. The silver market is unique in that it's not just driven by traditional supply and demand dynamics. Because silver is used in such a wide range of industries, from electronics to solar energy, its demand is relatively inelastic, meaning that even significant price increases are unlikely to deter consumption. This creates a situation where, as supply dwindles, prices could rise dramatically without a corresponding drop in demand. Croft's analysis suggests that we're approaching a tipping point. The combination of a persistent supply deficit and robust, inelastic demand is creating the conditions for a significant price breakout. For investors, this means that the time to position yourself in silver is now, before the market fully realizes the extent of this structural imbalance.
The last time was we're on 3-4 years ago. So there was, there certainly was a jump. I think most of it was really based on what had happened with COVID. The demand was up, and what we did see was that demand or the silver price gained and demand certainly increased and stayed up. Certainly because of a lot of the policies that were brought in, but we didn't see a huge jump in the silver price. And I think what happened was, before I talked about the silver supply, and when I talked about the silver supply, I said that silver supply was really from, if you look at total supply, coming from mining and from recycling. But it's important to consider that there are what I call a secondary silver supply, and this is what is above ground inventories. Now, these above ground inventories, up until about 2021, had been mostly accumulating. There were surpluses to the tune of anywhere from a few million ounces to maybe 40 or 50 million ounces for a few years. Well, those accumulated, and they ended up in different places like the futures markets. They ended up in ETFs, for example. And it's hard to estimate. Nobody knows exactly how much silver supply sits. You can look at these markets and get numbers from those markets, but there's obviously silver that people will own privately. Um, Corporations or funds will own physical silver privately as well. But the point being that up until about 2021, there were these smallish surpluses that kept accumulating in this secondary supply of silver futures and ETFs and private hoards. But where you can get this clear data is from the futures markets and from the ETFs. And only starting in about 2021, you saw silver inventories start to drop pretty dramatically. And, people kept asking me, Peter, how come the silver price seems like it's capped around the, 28, 29, $30 level? If there's so much demand and the demand is growing and there's a structural deficit, demand is at, more than 20% past supply.
To fully appreciate the potential of silver in the current market, it's essential to draw a comparison with gold, often seen as silver's more glamorous counterpart. The gold to silver ratio, a key indicator that tracks how many ounces of silver it takes to buy 1 ounce of gold, is a powerful tool for gauging silver's relative value. Historically, when this ratio is high, it signals that silver is undervalued compared to gold, offering a strong buying opportunity. Right now, the gold to silver ratio is hovering at historically high levels, indicating that silver is significantly undervalued. Cader Croth has been particularly bullish on silver, pointing out that the last few times this ratio reached similar levels, silver prices surged by as much as 300% to 400%. This pattern suggests that silver is not just poised for a rally, it's on the cusp of a major breakout that could see it outperform gold in percentage terms. But why does this ratio matter so much? The gold to silver ratio reflects broader market dynamics, including investor sentiment, market liquidity, and industrial demand. When the ratio is high, it often means that silver has lagged behind gold in recent market moves, creating a catch-up effect where silver prices rise rapidly to close the gap. This is exactly the kind of scenario Croth believes we're facing now, one where silver's underperformance relative to gold is setting the stage for a significant upward correction. What's more, the current economic conditions, marked by potential rate cuts, increasing industrial demand, and global uncertainty, are creating the perfect environment for this ratio to revert to more traditional levels. As this happens, silver could see explosive gains, particularly if gold continues its upward trajectory. Croth's analysis suggests that silver is not just a good investment, it's potentially the best investment in the precious metal space right now, offering far greater upside than gold. For investors, this is a crucial moment. Understanding the gold to silver ratio and its implications can help you position yourself ahead of what could be one of the most significant silver rallies in decades. And as Croth emphasizes, the smart money is already paying attention. Now is the time to make sure you don't miss out.
I don't have specific numbers for India actually right now, but what I can tell you is that I saw some research just recently that showed Chinese demand, and it is almost literally off the charts. This was research that showed 4 month return. A 4 month measure of silver imports into China, and they had set a record high going back about 15 or 20 years. So it was pretty phenomenal to see. I think it's a combination probably of investment demand as well as industrial demand. But I think, it's fair to say that if if you look at where most of the demand from China for silver is likely coming from, it's more than likely solar, given how it dominates solar production at a rate of about 80% of worldwide production. So that continues. And, if you look at the jump from 2022 to 2023, we saw an incredible 64% increase in the amount of silver going to the solar industry. So that was about 118 million ounces to 193 million ounces in 1 year. And now the Silver Institute forecasts that we're going to see this year's demand from solar go to about 230 million ounces. So another 20% increase over last year. So it's just phenomenal. And, I'd like to really point out something I think is significant. You can go back as far as 2015. So you go back 10 years. There has been no meaningful increase in total supply of silver if you look at supply coming from mining and from recycling. So that's about roughly, say, 15% from recycling, about 85% coming from mining. That's been right around 1 billion ounces for the last 10 years. And yet demand has grown to about 1.2 billion ounces. So we're in a structural deficit to the tune of about 20%. It's just really, it's phenomenal, really, what's been going on in this market.
So, where does this all lead us? After looking at the powerful forces at play, Fed rate cuts, soaring industrial demand, retail and investment dynamics, the global economic landscape, and a structural deficit, it's clear that silver is on the brink of a monumental rally. Peter Croft's expert analysis points to one conclusion. 2024 could very well be the year that silver breaks through to levels we haven't seen in decades, potentially reaching $50 an ounce or even higher. Croft has emphasized that the convergence of these factors is setting the stage for a perfect storm in the silver market. With the Fed expected to begin cutting rates soon, the cost of holding silver will drop, making it an even more attractive asset for both retail and institutional investors. Meanwhile, the relentless growth in industrial demand, particularly from sectors like solar energy and electronics, will continue to tighten supply. And as the gold-to-silver ratio suggests, silver is massively undervalued relative to gold, providing the potential for outsized gains as the market corrects this imbalance. But the most compelling part of this story is the timing. We're approaching a critical juncture where all these factors are about to align. The silver market is already tight, and as more investors wake up to the reality of this situation, we could see a rush into silver that sends prices skyrocketing. Croft believes that this is not just speculation. It's a highly probable outcome based on historical trends and current market conditions. For those who understand the significance of this moment, the message is clear. The time to act is now. Silver offers a unique opportunity, combining the safety of a precious metal with the explosive potential of an industrial commodity. If you've been on the fence about silver, it's time to consider making your move before the market takes off. And remember, while silver presents an exciting opportunity, it's crucial to approach any investment with due diligence and a clear understanding of your financial goals. Don't miss out on what could be one of the most significant investment opportunities of the decade. Subscribe to our channel to stay updated on the latest developments in the silver market and other investment trends, and as always, this is not financial advice. Make sure to consult with a financial professional before making any investment decisions.